Welcome back to our channel. The world stage has seen a whirlwind of activity recently, and today we're diving deep into a significant geopolitical and economic shift that's reshaping energy dynamics in North America and beyond. Stick around as we unpack the intricate details. And remember, we'll be drawing some important conclusions at the end of this analysis. A multitude of significant events have unfolded across the globe, each sending ripples through the international community. From political realignments to economic fluctuations, the landscape is constantly changing. Today, we focus our lens on a particularly compelling development: Canada's strategic pivot in its energy export strategy, a move with profound implications for its relationship with the United States, its burgeoning ties with Asia, and the global energy market itself. This intricate dance involves massive infrastructure projects, high-stakes political maneuvering, and the ever-present influence of global market forces. As we delve into this complex narrative, we aim to provide a clear, comprehensive understanding of the forces at play and what they might mean for the future. We encourage you to stay engaged, as the insights drawn towards the end will bring the entire picture into sharper focus. Before we proceed, if you find value in our analysis and want to stay informed on crucial economic and political developments, please consider subscribing to our channel and hitting the like button. Your support is incredibly important for helping us grow and continue bringing you in-depth content like this. Also, let us know in the comments where you're tuning in from. We love hearing from our global audience. The saga of the Trans Mountain Pipeline Expansion, or TMX, is a tale woven with ambition, controversy, and staggering sums of money. For decades, Canada, a nation rich in energy resources, found its vast oil reserves largely landlocked, primarily dependent on its southern neighbor, the United States, for export routes. The original Trans Mountain Pipeline, a crucial artery, transported oil from the heart of Alberta's oil sands to the Pacific coast in Burnaby, British Columbia. However, its limited capacity acted as a bottleneck, often forcing Canadian producers to sell their valuable crude at a significant discount compared to global benchmarks. The vision for the TMX expansion was bold: to triple the pipeline's capacity, thereby opening the floodgates for Canadian oil to reach lucrative Asian markets, bypassing the constrained U.S. system and fetching higher prices on the world stage. The project promised to reshape Canada's energy future, offering economic diversification and greater market access. However, the path to realization was anything but smooth. First proposed over a decade ago, the TMX expansion immediately ran into a maelstrom of opposition. Environmental groups raised alarms about the increased risk of oil spills, particularly concerning the sensitive marine ecosystems of the Salish Sea, through which tankers carrying the expanded oil volume would navigate. Indigenous communities, whose traditional territories the pipeline traversed, voiced strong objections, citing concerns over land rights, environmental impact, and the adequacy of consultation processes. The project became a lightning rod for national debate, pitting economic aspirations against environmental stewardship and Indigenous rights. Legal challenges mounted, creating significant delays and escalating uncertainties around the project's feasibility. The original proponent, the U.S. energy infrastructure giant Kinder Morgan, faced mounting financial pressures and regulatory hurdles. The political climate grew increasingly tense, particularly in British Columbia, where opposition was fiercest. The situation reached a critical juncture in 2018. Faced with Kinder Morgan's threat to abandon the project altogether due to the escalating risks and political roadblocks, the Canadian federal government, led by Prime Minister Justin Trudeau, made a controversial decision. In a move to ensure the pipeline's completion, Ottawa purchased the existing pipeline and the expansion project from Kinder Morgan for a hefty sum of 4.5 billion Canadian dollars. This intervention underscored the government's belief in the project's national strategic importance, but it also drew criticism, transforming a private sector endeavor into a taxpayer-funded enterprise. The construction phase that followed was plagued by further challenges: difficult terrain, unexpected technical issues, labor shortages, and the persistent shadow of legal battles and protests. The initial cost estimate of roughly $7.4 billion ballooned dramatically. By the time the final segment of pipe was laid, The price tag had soared to an eye-watering 34 billion Canadian dollars, more than quadruple the original projection. Despite the immense cost and protracted timeline, the expanded pipeline finally commenced commercial operations on May 1, 2024, marking the culmination of a long and arduous journey and signaling the beginning of a new era for Canadian energy exports. Please remember to watch this video until the very end, as we will be drawing important conclusions from these developments. For decades, the energy relationship between Canada and the United States was characterized by a distinct imbalance. Canada, blessed with abundant oil reserves, particularly in the vast Alberta oil sands, found itself heavily reliant on U.S. infrastructure and markets. Pipelines flowed predominantly south, funneling Canadian crude to American refineries. While this provided a steady customer, it came at a cost. Limited pipeline capacity heading south often created bottlenecks, leaving Canadian producers with fewer options and less bargaining power. Consequently, Canadian heavy crude, like Western Canada Select, WCS, frequently traded at a substantial discount compared to U.S. benchmarks like West Texas Intermediate, WTI, and global markers like Brent crude. This discount, sometimes reaching as much as $15 per barrel or more, represented billions in lost revenue potential for Canada annually. Historically, figures suggested that up to 98% of Canada's oil exports were destined for the United States, highlighting an extreme dependence. While more recent data indicates a slight diversification, with the U.S. still consuming around 60% of Canadian crude exports in recent years, the fundamental reliance remained a significant economic vulnerability for Ottawa. The U.S. market, while large, was also captive, dictating terms and prices to a large extent. This long-standing dynamic faced a potential seismic shock with the rhetoric and actions of former U.S. President Donald Trump. During his presidency and in subsequent political campaigns, Trump championed an America First energy policy, viewing trade relationships through a highly transactional and often protectionist lens. Concerns about potential disruptions to the deeply integrated North American energy trade began to surface. The most direct challenge came in 2023 and intensified leading into the 2024 election cycle, when Trump explicitly threatened to impose a sweeping 10% tariff on all imports, including Canadian oil and gas. This wasn't just political posturing. It represented a tangible menace to the Canadian energy sector's bottom line and the broader Canadian economy. A 10% tariff would directly erode the already discounted price Canadian producers received, potentially wiping out profit margins and jeopardizing the viability of future investments. The Canadian Association of Petroleum Producers estimated such a tariff could slash producer profits by up to $10 billion annually, a devastating blow. The threat sent shockwaves through Ottawa and provincial capitals, particularly Edmonton. Canadian officials publicly pushed back. Mark Carney, former governor of the Bank of Canada and the Bank of England, and often speculated as a future political contender, labeled Trump's proposed tariffs as fundamentally misguided, emphasizing the counterproductive nature of imposing duties on a close ally and crucial energy partner. The Trudeau government, while maintaining diplomatic channels, recognized the urgent need to accelerate Canada's diversification efforts. Trump's tariff threats, whether fully realized or not, starkly highlighted the risks of over-reliance on a single market, especially one subject to unpredictable political shifts. It added a powerful impetus to projects like the TMX expansion, transforming them from merely desirable economic opportunities into critical strategic necessities for safeguarding Canada's energy future and economic sovereignty against the vagaries of U.S. trade policy. The shadow of potential U.S. protectionism became a key catalyst driving Canada's determined push towards the Pacific. As the storm clouds of potential U.S. tariffs gathered, a new player stepped onto the Canadian energy stage, sensing a strategic opportunity amidst the uncertainty. Rongsheng Petrochemical Company Limited, a major private refining and petrochemical enterprise based in China, began making calculated moves. Rongsheng is not just any company. It's a subsidiary of the Zhejiang Rongsheng Holding Group and operates one of China's largest and most sophisticated single-train refineries, boasting a massive appetite for crude oil, specifically around 800,000 barrels per day. Crucially, this refinery is particularly well suited to processing heavy crude oil, the very type produced in abundance by Canada's oil sands. China, the world's largest oil importer, has its own strategic imperatives, primarily focused on diversifying its energy sources away from volatile regions like the Middle East and securing stable, long-term supplies to fuel its vast economy. Canada, with its newly expanded Pacific outlet via TMX and its vast reserves of suitable heavy crude, presented a perfect match. Quietly but decisively, Rongsheng established a presence in the heart of Canada's oil patch, setting up a trading office in Calgary, Alberta. This wasn't just a symbolic gesture, it was a clear signal of intent. From this Canadian hub, Rongsheng began negotiating directly with major producers. Their first significant move materialized shortly after the TMX pipeline became operational. Rongsheng struck a landmark multi-year crude oil supply agreement with Suncor Energy, one of Canada's largest integrated energy companies and a major oil sands producer. The deal specified that starting in June 2025, Rongsheng would purchase 200,000 barrels per month of Canadian crude, delivered directly through the Trans Mountain pipeline system to the West Ridge Marine Terminal in Burnaby for export. This agreement represented a tangible shift, locking in a significant volume of Canadian oil for the Asian market. Intriguingly, the structure of these deals, as reported by sources like the Globe and Mail, often involves free on board, FOB Vancouver terms. This arrangement is strategically advantageous for Rongsheng. Under FOB terms, the buyer, Rongsheng, takes ownership and control of the oil once it's loaded onto the tanker at the port of origin, Burnaby. This gives Rongsheng significant flexibility. If market conditions change or prices spike elsewhere, Rongsheng can potentially reroute these tankers to capture higher profits in other Asian markets, such as Japan or India. This practice, known as arbitrage, allows the buyer to capitalize on regional price differences. According to analysis by S&P Global Commodity Insights, this flexibility inherent in FOB deals could potentially earn Rongsheng an extra $2 to $3 per barrel compared to deals structured differently. For Canada, while potentially foregoing some arbitrage upside, the deal secures a reliable, large-volume customer outside the U.S. market, fulfilling the core objective of the TMX expansion and providing a crucial hedge against U.S. market volatility and potential tariffs. Rongsheng's strategic entry and the Suncor agreement marked the first concrete steps in Canada's pivot towards Asia, fueled by mutual strategic interests. Rongsheng Petrochemical's initial deal with Suncor Energy, while significant, appears to be just the opening gambit in a much larger strategic play. The Chinese refining giant isn't merely dipping its toes into Canadian waters, it's planning a substantial immersion. Industry insiders and energy intelligence reports suggest that Rongsheng has ambitious targets for its Canadian crude procurement. The company is reportedly aiming to secure shipping capacity equivalent to roughly 10% of the entire Trans Mountain expansion pipeline's throughput by the year 2026. Considering the TMX expansion boosted capacity to 890,000 barrels per day, a 10% share represents a substantial and consistent flow of nearly 90,000 barrels per day, heading directly to Rongsheng's facilities or potentially other Asian destinations via their flexible FOB contracts. This signals a long-term commitment and a strategic decision to integrate Canadian heavy crude deeply into their refining operations. To achieve this goal, Rongsheng isn't limiting its discussions to just Suncor. Reports indicate that the company's Calgary-based trading arm, operating under the name Auror, is actively engaged in negotiations with a wider array of major players in the Alberta oil sands. These reportedly include Cenovus Energy, another Canadian energy heavyweight which, according to its own reports, produced close to 800,000 barrels of oil equivalent per day in 2024, and Canadian Natural Resources Limited, CNRL, one of the largest independent crude oil and natural gas producers globally. Furthermore, Rongsheng is said to be exploring potential deals even with international supermajors that hold significant stakes in Canadian oil sands operations, such as BP and Shell. This broad engagement underscores Rongsheng's determination to secure diverse and substantial sources of Canadian heavy crude. This proactive approach aligns perfectly with China's broader national energy security strategy. As geopolitical tensions fluctuate and traditional supply chains face potential disruptions, Beijing is keen to reduce its dependence on Middle Eastern oil imports. Canada, viewed as a stable and reliable supplier with vast resources, and now, crucially, direct Pacific access, fits this strategy perfectly. The heavy, sour crude from the oil sands is particularly attractive to sophisticated Chinese refineries like Rongsheng's, which are designed to handle such feedstock efficiently. For Rongsheng and China, securing Canadian crude via TMX is a strategic imperative. The initial shipments are already being booked on very large crude carriers, VLCCs, massive tankers capable of carrying around 2 million barrels each, indicating the scale of the anticipated trade flow, as noted by Bloomberg reports. This burgeoning relationship, facilitated by the TMX pipeline, represents a fundamental reshaping of global energy flows, benefiting Chinese energy security while providing Canadian producers with much-needed market diversification and potentially better pricing power, moving away from the historical reliance on the U.S. market. While the Trans Mountain pipeline expansion provides a vital new route for Canada's oil exports, it's only one part of a larger strategic pivot towards diversifying energy resources and markets. The other major component of this shift is centered on liquefied natural gas, or LNG. For years, Canada's vast natural gas reserves, like its oil, were primarily exported south to the United States via pipeline. However, the global demand for LNG, particularly in energy-hungry Asian nations seeking cleaner alternatives to coal, presented a massive opportunity. Recognizing this, several large-scale LNG export projects were proposed for Canada's Pacific coast, aiming to liquefy Canadian natural gas and ship it across the ocean. The flagship project leading this charge is LNG Canada. Located in Kitimat, British Columbia, LNG Canada is a colossal undertaking, representing one of the largest private sector investments in Canadian history, with a price tag initially pegged around $40 billion. It's a joint venture led by the energy giant Shell, with significant participation from other international partners, including Malaysia's Petronas, PetroChina, holding a 15% stake according to Reuters, Japan's Mitsubishi Corporation, and South Korea's Kogas. The project involves constructing a large liquefaction facility capable of supercooling natural gas drawn from northeastern BC and Alberta into a liquid state, reducing its volume significantly for efficient transport by specialized LNG carriers. The first phase of the project is designed to export 14 million tons of LNG annually. Construction has been a multi-year effort involving thousands of workers, overcoming logistical challenges and the complexities of building such a large-scale facility in a relatively remote coastal location. LNG Canada is rapidly approaching its operational phase. The project developers anticipate the first shipments of LNG will depart from the Kitimat terminal by late 2025. These initial cargoes are primarily destined for the established high-demand markets of Japan and China. These nations are actively seeking secure, long-term supplies of natural gas to fuel their economies and transition away from coal-fired power generation. The International Energy Agency, IEA, forecasts robust growth in natural gas consumption in these regions, estimating an average annual increase of around 8%, driven by industrial needs and power generation requirements. LNG Canada is strategically positioned to capitalize on this growing demand, offering a stable supply from a reliable democratic nation. PetroChina's 15% stake in the project further solidifies the link to the Chinese market, ensuring a significant portion of the output will head directly to meet China's energy needs. The launch of LNG Canada, alongside the operational TMX pipeline, marks a significant milestone in Canada's quest for energy market diversification, establishing tangible pathways for both its oil and natural gas resources to reach global consumers beyond the United States. The monumental shifts in Canada's energy export landscape, driven by the completion of TMX and the impending launch of LNG Canada, are unfolding against a complex and evolving political backdrop, both domestically and internationally. The decisions made in Ottawa and provincial capitals are intrinsically linked to global geopolitics and trade tensions. The Trudeau government's significant financial commitment to TMX and its support for LNG development reflect a strategic imperative to reduce reliance on the U.S. market, a vulnerability starkly exposed by former President Trump's tariff threats. In June 2024, acknowledging the need to bolster Canada's position in international trade, Prime Minister Trudeau announced a $6.5 billion global markets accelerator plan. A substantial portion of this funding, $5 billion, is specifically earmarked to assist Canadian businesses, including oil and gas exporters, in accessing new international markets, particularly in the rapidly growing Indo-Pacific region. This initiative aims to provide resources and support for companies navigating the complexities of entering new trade relationships and diversifying their customer base beyond North America. Furthermore, recognizing the potential domestic fallout from U.S. trade actions, $1 billion of the plan is allocated to support Canadian farmers who might be negatively impacted by retaliatory tariffs or trade disputes. However, this strategic direction is not without its domestic political challengers. The Conservative Party of Canada, currently led by Pierre Poilievre, advocates for a different approach to energy infrastructure. Poilievre has been a vocal proponent of reviving the Energy East pipeline project. This cancelled project aimed to transport Western Canadian oil eastward to refineries in eastern Canada and potentially to an export terminal in New Brunswick, providing access to Atlantic and European markets. Conservatives argue that Energy East would enhance domestic energy security, reduce reliance on foreign oil imports in eastern Canada, and offer a stable supply to European allies seeking alternatives to Russian energy. This contrasts with the current government's focus on Pacific and Asian markets via TMX and LNG Canada. Provincial politics also play a crucial role. Alberta Premier Danielle Smith has championed the TMX expansion as vital for energy sovereignty, allowing the province to gain better prices for its resources and reduce its dependence on Ottawa's decisions and U.S. market fluctuations. Smith has optimistically projected that increased market access could generate an additional $500 billion in export revenues for the province by 2035. Yet, these massive energy projects continue to face scrutiny and opposition. Environmental groups maintain pressure regarding climate impacts and spill risks. Indigenous consultation remains a critical and legally complex aspect, as highlighted by past court challenges like the Squamish Nation case against TMX, which temporarily halted construction until the Supreme Court of Canada ruled in 2022, allowing work to resume after further consultation efforts. The political path forward requires balancing economic ambitions, environmental responsibilities, Indigenous rights, and navigating the unpredictable currents of international relations. While oil and natural gas dominate the headlines surrounding Canada's energy pivot, another significant, yet often overlooked component of its export portfolio is hydroelectricity. Canada is one of the world's largest producers of hydropower, particularly in provinces like Quebec and Ontario, blessed with abundant water resources. For decades, these provinces have exported substantial amounts of clean electricity to the northeastern and midwestern United States through extensive transmission networks. This trade provides a valuable source of revenue for Canadian utilities and offers U.S. states access to reliable, emissions-free power. In 2024 alone, major utilities like Hydro-Quebec and Ontario Power Generation exported a combined 42 terawatt-hours of hydropower to the U.S. According to Natural Resources Canada, this volume was sufficient to power approximately 4 million American homes for an entire year and generated around 2 billion Canadian dollars in revenue. This established energy trade highlights that Canada's energy relationship with the U.S. extends beyond fossil fuels. However, the strategic focus is undeniably shifting eastward across the Pacific. The completion of the $34 billion Trans Mountain Pipeline expansion, now pumping up to 890,000 barrels of oil per day towards the BC coast, is the cornerstone of this redirection. Complementing this is the $40 billion LNG Canada facility in Kitimat, poised to begin shipping 14 million tons of liquefied natural gas annually by late 2025, with PetroChina already locked in as a major stakeholder. These mega projects fundamentally alter Canada's energy export capabilities, creating robust pathways to Asia's burgeoning markets. This diversification is driven by a desire to escape the price discounts associated with the captive U.S. market, often $15 per barrel, and mitigate the risks highlighted by potential U.S. tariffs, which could cost the Canadian industry $10 billion yearly. China's Rongsheng Petrochemical exemplifies the new Asian demand, aggressively securing Canadian crude through its Calgary office and deals with Suncor, Cenovus, and potentially others, aiming for 10% of TMX capacity. The implications for the United States are significant. U.S. refiners, particularly on the Gulf Coast and in the Midwest, have long relied on discounted Canadian heavy crude, processing roughly 3.9 million barrels daily. As more Canadian barrels flow west to Asia, these refiners may face tighter supplies and higher costs. Analysts at Wood Mackenzie suggest they might need to turn to more expensive alternatives from Saudi Arabia or Venezuela, potentially driving up costs by $5 to $10 per barrel. Furthermore, Goldman Sachs predicts that reduced Canadian supply could contribute to an 80-cent per gallon increase in U.S. gasoline prices, a politically sensitive issue, especially in an election year. For years, the U.S. consumed nearly all, historically 98%, more recently 60%, of Canada's oil exports, totaling 200 billion Canadian dollars in energy trade in 2023, according to Statistics Canada. That era of overwhelming dominance appears to be ending. Let's draw some conclusions. Canada is undeniably executing a major strategic pivot in its energy policy, driven by economic necessity and geopolitical considerations. The completion of the costly but crucial TMX pipeline and the imminent launch of the massive LNG Canada project represent a historic shift away from decades of overwhelming reliance on the United States market. The primary motivation is to gain access to the vast and growing energy markets in Asia, particularly China, Japan, and South Korea, where Canadian resources can potentially command higher prices and reduce vulnerability to U.S. trade actions, such as the threatened 10% tariffs proposed by Donald Trump. China's strategic move, exemplified by Rongsheng Petrochemical, establishing a Calgary hub, and securing long-term deals with major producers like Suncor, underscores the mutual benefits perceived in this new energy relationship: supply security for China, market diversification for Canada. While hydropower exports to the U.S. remain significant, the momentum and major investments are clearly focused on facilitating oil and LNG flows across the Pacific. This shift signifies Canada's ambition to reposition itself as a more independent global energy player, looking towards Asia's $15 trillion energy market and the broader $47.9 trillion Indo-Pacific economy. However, this pivot is not without risks. The massive cost overruns of TMX highlight the financial challenges, while environmental concerns and indigenous relations remain complex factors. Furthermore, the potential response from the United States, facing the prospect of tighter supplies and higher energy costs for its own refiners and consumers, adds another layer of uncertainty. Tariffs or other trade measures could significantly impact Canadian producers' profits, even with diversified markets. Canada is placing a high-stakes bet, redrawing its energy map in a bid for greater economic sovereignty and access to global markets. But the final outcome of this complex geopolitical and economic realignment remains to be seen. The deep energy ties that bound North American neighbors for generations are undeniably beginning to fray as Canada charts its new course westward.